Hello again, everyone, and welcome to another episode of Five Plan Partners Educational Vlog Series. My name is Mark Human. Today, we're going to be talking about being self-employed and saving for retirement. So when we really simplify the basic categories of being self-employed, there's four categories. One is that you're on your own, you're solo. Another is that you don't really have enough cash flow to pay for a more elaborate 401k plan, but you still have employees that you want to cover or need to cover so that you can fund a retirement plan yourself. Then there's your standard 401k that most of us are familiar with employee contributions and employer matches in many cases. And then finally, if you're a business owner with multiple companies, what are some of the complexities that you need to be aware of when you're setting up various retirement plans? So let's start with the options for a solo plan. I really see it as two basic options if you are working in a solo capacity. And technically, this can also apply if your spouse is working with you, but no other W-2 employees beyond the scope of just yourself or yourself and your spouse. Those two options are a SEP IRA and a solo 401k. Now, technically, you can have a SEP IRA when you have multiple W-2 employees outside of your spouse, but in a lot of situations, it may not make sense because you apply a specific percentage of your salary for your deferral, and then you apply the same percentage of salary for your other employees. This may be a little bit more than you want to contribute for those other employees, and so that's why a SEP IRA may not make sense in a lot of situations for employees beyond you and your spouse. For a SEP IRA with a single employee, it's pretty simple. The money that you put in reduces your taxable income. You defer it it's on a tax deferred basis, and you commit those dollars till at least age 59 and a half. Otherwise, you're going to pay some penalties if you pull it out. So you always want to have the mindset that this money is for retirement. This money is for beyond my working years today, and it's for when I'm in my 60s. If your income is a lot higher right now than it will be in your retirement years, a SEP IRA is the most simple solution to deferring taxable income today and building up retirement assets for later. A solo 401k is another option to use if you're the only person involved in your business, and it can also apply if your spouse is involved in your business, but it can never apply if you have other W-2 employees beyond yourself and your spouse. A solo 401k can offer only pre-tax deferrals, both on the employer and employee side. That's one of the really unique things about a solo 401k is you have to think of yourself as the employee, but also yourself as the employer. Additionally, a solo 401k can have a Roth component on the employee side, and that can be advantageous if you think your income today is lower than it will be later on when you're withdrawing these assets. Technically, there are some legal differences between the SEP IRA and the solo 401k, but that's a little too complicated for this short educational vlog series, so we won't go down that path. That's a really great, more in-depth discussion to have with your advisor. Next, let's move on to the least expensive option when you have multiple employees and you want to be able to fund a retirement plan for yourself. This will require that you're contributing to the accounts of those employees, but you have a couple of different options. That plan is called a simple IRA. A Roth component is available for simple IRAs these days, and it works very similar to a 401k in that you can make your deferral as an employee on a pre-tax basis, or you can make it into a Roth account. And then the employer match is always going to go into a pre-tax account. So what are the options for that employer match? You can either contribute 3% for all employees, regardless of whether they participate, or you can match those employees that do participate 2% on a 2% deferral. The simple IRA is a really easy way to get into saving for retirement and providing a retirement savings vehicle for your employees while minimizing the expenses it costs to establish and maintain the plan. One important detail about a simple IRA is that the deferral limits, the amount that you can defer in a given calendar year, are a little bit lower than they are in a 401k. The maximum deferral into a simple IRA for an employee in calendar year 2022 is $14,000 if you're under 50 years of age. And if you're over 50 years of age, you get an additional $3,000. So your total deferral is $17,000. By comparison, a 401k will allow you to defer up to $20,500 if you're under 50 years of age. And then your catch-up provision, if you're over 50 years of age in the 401k scenario, is $27,000. So that is an important consideration if you're looking to really stockpile as much assets as you can as you're approaching retirement. Speaking of the 401k, that's the third option and the most popular option, the one that we're all fairly familiar with. 401k works pretty simply. The employee chooses the amount to defer. Sometimes they're incentivized, and often they're incentivized with a match from the employer. For instance, an employer can say, if you will contribute 6%, we will match 3%. That's a very common contribution and match incentive that we see, and that ensures that the employee has incentive to save for retirement. 401ks are available on a pre-tax basis and a Roth deferral basis for employees, but you're always going to have the employer contribution go into a pre-tax account. So it's important to understand that if you're contributing 6% and getting a 3% match, only that 6% is going into the Roth account, while that 3% from the employer will always be in the pre-tax account. If you are a business owner planning to offer a 401k, it's important to understand that if you want to really load up and you want to maximize your contributions, that you understand safe harbor elections and what annual testing means, so that you know the amount of benefit you'll have to provide for your employees in order for you to defer the maximum amount. That's another really complicated discussion that's best served one-on-one with an advisor who specializes in 401k employer retirement plans. The IRS has laid out guidance if you have multiple businesses and you have 401ks at each business, that they're all treated relatively equal, and there's no opportunity for you to discriminate against one set of employees versus another. Another great example of that is that you have a business that has 20 employees and you set up a solo business to provide consulting services to this other business. And you do that in order to stockpile all your 401k savings into that plan where it's a solo, where you can maximize your deferrals and not have to pay attention to any safe harbor guidelines. The IRS has squashed that, and you have to consider the two together, and you have to apply the same benefits to both plans equally so that you don't discriminate against other employees. So what we've given you today is an overview of if you're self-employed and how you can save into retirement plans. We've outlined four basic categories: whether you're by yourself, whether you're just getting started with employees and really are cost conscious, that's the simple IRA. The standard 401k has a number of important guidelines that you need to be aware of, and work closely with an advisor to make sure you adhere to all of the ERISA and IRS guidance. And then if you have multiple companies, you're not allowed to discriminate versus one set of employees over another. And it's really important that you follow those control person rules very carefully. So if you have any questions, we do a really wonderful job of advising our clients who have 401k plans, making sure they're in compliance with all ERISA laws and all IRS guidance. And we would love to talk to you about that topic. So for all of us at Five Plan Partners today, we hope you enjoyed this educational vlog series. And we look forward to seeing you next time.